While Wall Street fixates on the EV slowdown, Garrett Motion's 25% surge reveals a massive hardware arbitrage in hybrid turbocharging. This isn't a legacy bounce. It's a structural re-rating of the high-margin components required for the mid-transition era that the market is only now pricing in. We begin with the institutional conviction driving Impinj's 81% volume spike in today's breakout. GTX earns a 71 out of 100 by the hardware, not the hype. Garrett's turbochargers now command 68% attach rates on hybrid powertrains, up 12 points YoY, yet the stock trades at 4.2x EV/EBITDA. That multiple ignores $1.3 billion in backlog tied to 48 mild hybrid platforms launching in 2026. The data teardown reveals a margin inflection hiding in plain sight. Garrett's 24.99% surge is anchored in a hardware reality Wall Street missed. Their e-turbo architecture sustains 200,000 revolutions per minute, rotations per minute, the speed at which the turbine wheel spins to compress air, while surviving 1,000 degrees Celsius exhaust temperatures. This is not a simple mechanical upgrade. It is a power electronics victory. While competitors like BorgWarner struggle with the power density, the amount of electrical power used per unit of volume required for 48V integrated motor generators, Garrett has solved the thermal soak. Thermal soak is the residual heat that migrates into sensitive electronics after the engine shuts down, often destroying substandard components. By integrating a high-speed electric motor directly on the shaft between the turbine and compressor, Garrett effectively eliminates turbo lag, the delay in power delivery before exhaust gases spin the turbine. The lab views this hardware lead as a structural moat because Garrett's silicon carbide (SiC) inverters, power electronics that convert direct current from a battery into alternating current for a motor, operate at 99% efficiency. This efficiency is critical for the hybrid transition where every watt of energy recovery determines emissions compliance. While the market obsessed over pure EV plays, Garrett secured the high-margin performance hybrid niche. Today's $25.61 price reflects a fundamental repricing of their intellectual property in e-axles, integrated drive units combining the motor, transmission, and power electronics into one housing. With institutional volume 53.1% above the average, the smart money is finally valuing Garrett's ability to handle the TDP, thermal design power, the maximum heat a cooling system must dissipate, of modern high-output engines. Garrett owns the cooling curve. Garrett Motion is the primary beneficiary of a bifurcated trade landscape where 3.64% interest rates, the cost of borrowing from the central bank, force a pivot from speculative dreams to cash flow positive hardware. While the Fed holds rates steady, the yield curve is finally normalizing. The return to a state where long-term debt yields more than short-term debt, with a plus 0.52% spread. This normalization signals a return to industrial sanity. With CPI, the Consumer Price Index measuring the average change over time in prices paid by consumers, at a stagnant 0.6%, the real pressure isn't inflation, it's the cost of capital. Garrett's 5.6% revenue growth proves it can outrun the 4.36% 10-year yield, the interest rate the U.S. government pays to borrow for a decade, while competitors drown. The lab sees the Fed's pause as a green light for R&D, the research and development spending required to innovate, as boards pivot toward tariff-proof domestic manufacturing. The macro environment has shifted from a monetary battle to a geopolitical siege. As trade friction escalates, the threat of a $143 million hit to specific consumer goods highlights the fragility of globalized logistics. Garrett sits in the eye of this storm, protected by a hardware moat that Wall Street ignores. While the Export Administration regulations that control the export of dual-use technologies tightens on high-end silicon, mechanical efficiency remains the ultimate hedge. Political rhetoric is moving toward a K-shaped recovery, an economic situation where one sector thrives while another plunges, and Garrett is on the upward stroke. Investors are fleeing to quality as the risk of a recession, a period of temporary economic decline, sits at a low 6.8% according to Kalshire Markets. The verdict is clear. Garrett's 25% surge is not a fluke, but a calculated flight to engineering resilience in a fractured world. Garrett Motion's earnings call opened with a victory lap, record Q1 revenue, AI-driven turbocharger demand, and a full-year guidance raise that sent the stock surging. Management leaned hard on structural growth and supply chain resilience, framing the beat as proof of an inflection point. But let's zoom in on the insiders. 480,000 shares net sold in the last 90 days. That's not a trickle, that's a fire hose. When executives dump nearly 500,000 shares while the stock pops on earnings, it's not confidence. It's cashing out before the narrative cracks. Historically, this pattern precedes margin compression or a demand slowdown, not a breakout. The EPS beat, 14.9% above estimates, looks like strength, but dig deeper. R&D spend isn't disclosed, but CapEx trends show investment lagging revenue growth. That's a red flag. If Garrett were truly betting on AI-driven demand, we'd see R&D accelerating, not coasting. Instead, management pivoted to shareholder returns language, a classic pivot when the product pipeline lacks conviction. And let's talk about that supply chain optionality line. Translation: they're hedging against geopolitical risk because their margins are exposed to tariffs and export controls. The 10Q would have flagged this if they'd filed it yet. What management is saying is growth story. What the lab hears is, we're milking the cycle while we can. The insiders already know it. Garrett Motion is riding a massive hybrid tailwind that the market is finally pricing into the hardware. Hybrids require advanced turbocharging to maintain thermal efficiency, the ratio of work performed to the heat energy released by fuel. With trading volume 53.1% above the 20-day average, institutional conviction is high that Garrett's silicon-integrated boosting systems remain the essential bridge to an electrified fleet. The immediate risk is a structural decline in the total addressable market as full electrification removes the need for turbochargers entirely. Furthermore, Garrett faces tightening margins from export administration regulations that control the shipment of dual-use technologies. If trade friction escalates, the cost to navigate these localized supply chains will eat the forward P/E, price-to-earnings ratio based on forecasted income, of 12.3x alive. The question every institutional desk is avoiding: can Garrett's engineering pivot fast enough to offset the one-to-one loss of internal combustion revenue? The lab's answer is found in their R&D allocation toward high-speed electric motors. While the RSI, Relative Strength Index, a momentum oscillator measuring Impinj just earned a 68 out of 100. The lab is buying. Their Monza R700 UHF RFID die, at just 0.18 mm superscript 2, is now shipping in 300mm wafers at 92% gross margins. Wall Street's missing the yield ramp. Every 1% uptick adds 4 cents to EPS. The data teardown reveals a supply chain choke point that's about to break wide open. Impinj's dominance is secured by its M800 transition to 300mm wafers, large silicon disks that allow for more chips per batch, which effectively doubles the gross margin potential per die compared to legacy 200mm production. While Wall Street obsesses over retail inventory, the engineering reality is the M800's minus 24 dBm sensitivity, a measure of the minimum signal power required for the chip to wake up and respond. This threshold allows for reliable reads at distances exceeding 10 meters, even in high-interference industrial environments. Competitors like NXP with their UCode 9 series struggle to match this specific combination of low power consumption and high read rates. The lab tracks the die size at approximately 0.1 mm superscript 2, a physical limit where any further reduction risks compromising the antenna impedance matching, the alignment of electrical resistance between the chip and its aerial. This 20.73% surge to $144.92 is not a sympathy move with Caterpillar. It is a validation of Imping's mastery over SIP, System in Package, the technology that integrates multiple functions into a single protective enclosure. As industrial giants automate, they require the M800's enhanced auto-tune feature, a self-adjusting mechanism that compensates for the detuning effects of metal and liquid. The market is finally pricing in the shift from high-volume retail to high-reliability industrial applications. With the RSI, Relative Strength Index, a momentum oscillator measuring price speed, at 88.5, we see extreme institutional accumulation despite the overbought signal. The lab views this as a fundamental repricing of the hardware's reliability in harsh environments. Today's volume, 81.1% above the 20-day average, confirms that the physical superiority of the M800 architecture is now the baseline for the industrial Internet of Things. Impinj is the primary beneficiary of a 19.6% short float. The percentage of shares held by investors betting the price will fall, squeeze as industrial giants weaponize inventory data to survive escalating trade friction. While the Fed holds rates steady at 3.64%, the real story isn't monetary. It's the normalizing yield spread, the difference between long-term and short-term interest rates, at plus 0.52%. This normalization signals that the era of cheap capital is over, forcing companies like Caterpillar and Wesco to find efficiency through hardware, not just debt. With CPI, Consumer Price Index, a measure of the average change over time in prices paid by consumers, at a negligible 0.6%, the friction isn't domestic inflation but the looming wall of tariffs. Boardrooms are aggressively pivoting R&D, research and development, budgets toward RAIN RFID to map every node in their supply chain before the trade war escalates. The lab tracks the 6.8% recession risk as a secondary signal to the primary threat, shifting D. 5 country designations, specific government classifications used to restrict tech exports to certain nations. As global trade faces renewed tariff uncertainty, Impinged 1.66 beta, a measure of a stock's volatility compared to the overall market, makes it a high-velocity vehicle for investors fleeing monetary risk for physical reality. The 20.7% surge today isn't just a reaction to upbeat earnings from peers. It's a flight to quality in an environment where Jack Daniels and Jim Beam are already facing $143 million in trade war costs. Management teams are realizing that tariff-proof pay structures won't save margins if they can't track goods across borders in real time. In a K-shaped recovery, an economic situation where different sectors recover at different rates, the visibility Impinj provides is no longer a luxury. It is a geopolitical survival tool. Segment 3. The PR Insider Filter. Impinj Incorporated. Impinj press releases are dripping with AI-driven RFID demand and supply chain resilience. But let's cut the PR fluff. Zero insider selling in 90 days? That's the first red flag. Executives aren't dumping stock, but they're not buying either. When insiders go radio silent, it's not confidence, it's paralysis. They're waiting for something, likely the next earnings print or a Qualcomm-sized catalyst to justify their $175 price targets. Management's language is surgical. AI demand isn't about revenue today, it's a hedge. They're papering over last quarter's 4.8% EPS miss with forward-looking buzzwords because the current RFID market is slowing. And while they tout supply chain optionality, what they're not saying is that their CoWES packaging yields, chip-on-wafer, the tech that stacks dies for performance, are still below 80%. That's a margin killer, and it's buried in the R&D spend. R&D hit $103 million, 28.4% of revenue, up 3.8% YOY. On paper, that's innovation. In reality, it's desperation. When R&D grows faster than revenue, it means the pipeline isn't converting to sales. Impinj's not scaling, it's treading water. And while 425 institutions are piling in, that's not conviction, that's FOMO. The top 5 funds are buying because they have to, not because they want to. What management is saying, we're leading the AI RFID revolution. What the lab hears, we missed earnings, our yields are weak, and we're one supply chain hiccup away from. The lab sees institutional conviction in the 81.1% volume surge over the 20-day average. This isn't retail noise. It's a bet on Impinj's dominance in RAIN RFID, radio frequency identification technology using the GS1 UHF. GTX 7nm yield ramp hit 92% in Q1. No one's talking about this. That's the margin inflection Wall Street missed. PI's substrate lead is now a structural moat, not just a story. Both buys, but the real edge is in the numbers, not the headlines. Drop a comment. Should we tear into AMD's MI325 roadmap or NVIDIA's Blackwell yield curve next? Your call. Hit subscribe, smash like, and let's keep the signal high. This isn't financial advice. We're engineers, not brokers. Markets change, data gets stale, and past performance never guarantees future returns. Do your own research. Always. The lab's out. Stay sharp.